Thank you for joining me again.
Thank you for having me.
So we are on the last announcement of the year.
That's correct.
So we've
Yep.
had 8 this year, 4 have been reductions.
Yep.
I'll let you
Yep.
take it from there. What happened today?
It was predicted that they weren't going to be adjusting the interest rate today, and they didn't. They stayed fast. Interestingly, though, the US Fed dropped their rate by a quarter point
Mm.
today. I
Was
feel
that
like that,
expected?
yes, because I think there's a lot more pressure from Donald Trump on bringing down the rates. Their base rate is higher than ours anyway, so there's more room. They've not reduced like we have. So
Yeah.
it makes sense that they would want to drop some rates.
But what are you looking towards for the new year?
Well, the January meeting, I don't think is going to have a rate drop. The unemployment numbers just came out, but the inflation numbers and housing data come out on Monday. And so
Okay.
those two may give us some more insight as to whether January will be some reductions. At the moment, our economist, Dr. Sherry Cooper, said she doesn't think January is going to have any reduction, but she does think there'll still be another one built in the March meeting. So what happened was the unemployment rate was actually lower than they predicted. A lot of the
Mhm.
jobs were part-time jobs. So in the chief economist's idea of part-time jobs is they're lower income jobs. Some of it was already built into speculation because of obviously Christmas rushes. They want to, employ part-time work. But I guess there was more than they expected. So that
Mm.
brought the unemployment numbers down, which kind of kept the rest of the balance in check for keeping the rate the same for this meeting. So we expected
Okay.
it.
Okay. Okay. So nothing earth-shattering there, nothing too crazy.
No,
I did ask you if we could talk a little bit today about the first-time home buyer incentives, and I think we've touched on it before, but I think it's worth sort of recapping some of the benefits and the programs that are out there for first-time home buyers.
absolutely.
So let's start with the first-time home buyers savings account.
Absolutely. And it'll
Okay.
tie into your RSP. I'll do a segue for the RSP. So the
Okay.
first time home buyer savings account, you can put up to $8,000 a year into the account to a cumulative value of 40,000 contribution. That is considered a tax-free deduction on your income taxes, similar to an RSP. And interestingly, it doesn't affect your RSP figures. So in
Okay.
order to open a first-time home buyer's account, you have to be a first-time home buyer, as the definition would sound, but you can also be, which is misleading and sometimes clients aren't aware, you can also haven't been a homeowner for 4 years and now
Okay.
qualify again as a first-time home buyer. The nice thing about that is if you've gone in the market, gotten out of the market, and now are thinking to get back in, if there's a window of 4 years between those times, you can open up the first-time home buyer's account.
Is that because our market can change so much in 4 years that you are kind of starting from scratch?
I'm not sure. It's the same as an RSP, actually. If you withdraw your RSP for home buyer's withdrawal plan, and then 4 years between that time passes, you can do another RSP withdrawal first-time home buyers again, even though you're not a first-time home buyer. So possibly because that was already in place for the distance of time that they needed in order to define you again. Maybe they think if you're out of the market for that long, then you deserve to be able to have a
Mm.
break to come back in. I'm not
Okay.
sure.
Okay. And so you were saying the 8,000 a year, then that does not take away from what your amount for your RSP
RSP
contribution. Yeah.
contribution room, and your RSP contribution room is directly related. It's capped, but it's directly related to the amount you report on your income taxes. So it's 18%, I believe, of what your income tax is, up to a maximum of like 31,000 you can do a year on an RSP contribution.
And does your
Um,
unused portion carry over?
yes, it absolutely does.
And is
Same
that
with
the
the
same
first
for
time
the
home buyer. Yep.
okay.
Yeah,
Okay.
that carries over as
Amazing.
well. And so then to take it out of the plan, you could take your first-time home buyers in a one-time lump sum withdrawal. And then obviously you have to have a bona fide offer and you have to go through the same paperwork or similar paperwork as you would with an RSP withdrawal. And then your RSP, you can take an additional 60,000 per person. So in a household of two people who qualify and have saved enough, you could take up 120,000, and then you could in theory take another 80,000 of your first-time home buyers for those two savings accounts if you capped them both at 40,000 each. So
So
there's
it's per person
per
on the
person.
contract.
Yeah,
Okay.
not per home,
Per
single
person.
person. Yeah. Yeah. So
Okay.
the downside, the first time home buyers, you don't have to pay back, obviously, because it's a savings within a savings. but the RSP you have to pay back. So when you're taking an RSP withdrawal, the year you take it out, you don't have to pay it back. But after that, you pay back 1/15 every year for the next 15
Mm.
consecutive years. You can pay it back sooner, which in some cases are if you are on, if you've sold your home in 5 years, then you can pay back that RSP in one fell swoop rather than have to wait for the 15 years consecutively to repay it, which is brilliant.
Okay. Okay.
But otherwise, if you do nothing, if you don't pay it back, and if you've been living in the home and you haven't sold it, then the government will take 1/15 of that calculation and add it to your income as income. So if you don't pay it back in the timely fashion of the 1/15 a year, the following year after you've withdrawn it, then after that, the government adds that to your income 1/15 of whatever the formula was that you took out. So it's calculated either way. You have to pay it back or the government adds it to your income.
Interesting. So you're
Hmm.
essentially borrowing it from yourself.
You are, yeah. And the
Yeah.
downside
Okay.
to taking it out, the RSP is obviously you take it out, but when you put it back in the 1/15, it doesn't count towards your contribution again, obviously, because you would be double
Mm.
dipping that way. You got the benefit the first time when you made the contribution against to reduce your income taxes. So when you pay it back, you don't get that contribution again. So in some ways, I always work it out for a client when they're looking to take their RSP out, whether it makes sense to do it or not. So for
Mm.
instance, in some cases, it makes sense because the client can't get into a property without taking that RSP out. But if the client can get into the property and it works in the formulas without needing that RSP, I often get asked, can I just take out my RSP to reduce the amount of my mortgage by that amount I'm taking out of my RSP? And it's not advisable if you don't need it, if you're just trying to make a bigger deposit, because you obviously have to pay back the 1/15. So that adds to a mortgage amount. On top of that, you have another budget item in
Right.
your annual or monthly budget. And two, you lose all the room of that gain from the time it was in there and all the
Mm.
returns it would get otherwise. So you lose that. And then you're obviously paying it back. So you only chip away at repaying it rather than a lump sum where you get the gain over 15 years. Basically, what I'm looking for at the time I'm working with a client is when you put less than 20% down, which often first time home buyers don't hit that first threshold of 20%, then you have to have an insured backed mortgage. Now, the insured backed mortgage is calculated or factored depending on the loan to value amount. So for instance, if you're buying a property and only putting 5% down, your purchase price is under 500,000, 5%, that formula is the most expensive. And then if you can hit
Mm.
10%, that formula drops a little bit. If you can hit 15%, that formula drops again. And if you can hit 20%, you lose the formula entirely for the insurance premium because you no longer require it. So when
Right.
I have a client that is making a down payment and they have access to a limited amount of money, then I would be more inclined to look at that RSP to be able to get them through a threshold to a cheaper insurance premium. If they've already
Mm.
reached a 10% but can't get to 15, then that's when you start to work out what the difference is between taking out the additional RSP money, but you've not hit the next threshold of that insurance. So it changes at 5%, 10%, and 15%. And obviously at 20, it goes away. And so if a client has hit 15%, but by doing his RSP, he gets to 18% or
Mm.
19%, but doesn't get to 20. I'm exaggerating because if he gets to 19, we're going to try and find a way to get him to 20.
Right.
But in a normal circumstance, if he gets within a threshold between two brackets, then I would want to try and calculate out whether adding his RSP benefits him or
Mm.
her, benefits
Mm.
them from being able to qualify for a lower bracket.
So what you're saying is somebody like you can help somebody navigate all of the things
Absolutely.
that none of us know anything about. Okay,
Yes.
so going back to the first time home buyer's savings account, if the total room that you have to deposit into carries over, and you may not necessarily be able to do 8,000 this year, should you open it so that you can get
Absolutely.
started? Like if you
Absolutely.
thought, oh,
Because
in 4 or 5 years, I'm going to be able to buy, but I can't do 8 grand today. Maybe I can do $500 because
100%,
then
because
in
you
three
carry over the
weeks,
7,500 for next year and you get a new 8,000 for next year
yeah.
and so on and so
Okay.
forth. 100% do it now. And then certainly in this
Yeah.
timing of the last few weeks of 2025, it would make
Yeah.
sense if the client qualifies to get that first time home buyer's account open.
So if you think in the next 4, 5, 6 years you're going to buy a house, open that account now. Throw $200 in it. See what
Yeah,
happens
and
next
put
year.
money in your RSP, because your RSP
Mm.
saves twofold. One, I mean, don't necessarily put all your money in your RSP. If you have other sources, then keep it from balancing out your sources. Figure out what your best amount in your RSP contribution is to give your best benefit of return, and then put the rest in a tax-free savings account. Because that's the other one you have, is the tax-free
Right.
savings account. So there's several ways the government is incentivizing people to save money for future homes.
Okay, so some of the other perks, the property transfer tax exemption.
So the property transfer tax exemption has gone up to 835,000 as the max purchase price. It's actually 860 or 865, but it tiers in a tiny calculation between 835 and 860. So let's just say it's 835 for the full maximum amount. What happens is, in the past, the government would give you 100% property transfer tax exemption to a purchase price of 500. And then they went to 725, and there was a full exemption there. Now what they do is you can go all the way to 860 or 835, depending on how you look at it, and you get the first 500,000 property transfer tax exempt. So where you would normally pay $8,000 for that first 500,000, you're exempt for 100% of that first 500,000. And then anything above that is 2% on the calculation. So for instance, if you bought something for 600,000 and you were a first time home buyer, instead of paying, so six would be $10,000 of property transfer tax, you'd pay two. So you'd only pay on the portion above the 500,000.
So it's a significant difference.
It's significant.
Yeah.
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 And the criteria for the property transfer tax is that you can't have owned property anywhere in the world before that's your primary residence. So the misunderstanding is
Okay.
that some people can be on a cottage with their family
Mm.
in Ontario, and that then precludes them from being able to have a property transfer tax exemption on their purchase. And that's not the case. If they have a property they've never claimed as their primary residence, and they've never claimed anywhere, anytime, then they would have the potential for that property transfer tax exemption. You don't have to be a first-time home buyer for this, but if you buy a property and it has GST, there are GST rebates. For a first-time home buyer, the GST rebates up to 1.1 million at the purchase price. You're actually exempt for all the property transfer tax, not that prorated amount that I just mentioned.
Hmm.
And you're entitled to a GST refund for up to 1 million. And then after between 1 million and 1,500,000, it's again a formula. So where you would normally pay 5% on a purchase of 1 million would be 50,000, you would be exempt from that as a first time home buyer because you get the GST back. And then there's a small home buyer's tax credit on your tax return you can claim as a first time buyer. But as an owner, you have a annual property taxes. And there is a homeowner's grant within that for
Right.
most owners, depending on the value, because at some point in the value it drops off. But for the condos and townhomes we're referring to, Pemberton, Squamish, Whistler, in the lower edge bracket, then they would be entitled to the homeowner's grant as well as a homeowner of that property. So there's a few incentives there.
Mm.
Well, there's the 30-year amortization for
Oh,
first-time
right.
buyers. So where originally up to $1 million, you'd have to put 20% down over $1 million. And now
Yeah.
the government just last year introduced that, or just this year, pardon me, they just introduced that you can now put up to 10% down in a small formula, but 10% down up to a purchase of 1.5. And then that isn't for a first-time home buyer, but you have to have a 25-year amortization if you're not a first-time home buyer in that scenario, or you can have a 30-year amortization if you are a first-time home buyer. So it allows the borrower to qualify for a bit more when they are a first-time home buyer up to that purchase of 1.5, where
Mm.
originally it was cut off at $1 million.
Is there still a 5% down option, or is that just
5% up to 500,000, and
Oh,
then
okay.
10% of the portion above the 500,000. And it's a broken formula, broken down formula. So I just kind of say 10% once you get up into the million age range, because it's 25,000 on the first 500,000, and then it's 10% on everything above 500,000.
Okay, so first time savings account, property transfer tax exemption. We've got longer amortization periods, lower
Yep.
down payments, homeowner
RSP
grants,
withdrawal,
GST,
most part.
RSP. Yeah.
Yep. Yep.
So what else can we give to our first time home buyers? Anything else?
No, but one of the common questions that is overlooked quite often is if a home buyer can't afford on paper the property, we can add a cosigner to that
Mm,
application. So a cosigner is often supposed to be a family member, a close family member, parent, sibling. But the advantage of that is that now their application, their income, their assets, their liabilities all come into your application. And in essence, they can help you qualify for a number that you might not otherwise qualify for. The misconception sometimes can be that then that means my parent is on my title for the rest of my life.
mm.
No, the moment you're able to qualify on your own, you can apply to take them off the mortgage and title entirely. The
Okay.
downside to having them on is quite often the lender will demand or dictate that the parent be on title of the
Mm,
property. So the difference between a cosigner and a guarantor is a cosigner is on title, a guarantor is not on title. Both of them act the same way, that help you qualify for your mortgage, are ultimately responsible if you don't make your
mm.
payments, but one is on title, one isn't. So my little secret, which isn't probably a big secret, but what happens is for clients that are trying to qualify and I have to have a parent on title, I'll have the lawyer dictate that I ask the lawyer to just put them on at 1/100th or 1/1000th of an owner. And so from the bank's perspective, the borrowers are all on title, so we've been compliant. But from the owner's perspective, the child in this situation will be 99.9% owner, and the parent is just a small portion owner.
Mm,
And the advantage there is that when there's, say that child were to sell a home, the parent would be in a capital gains position for any gain because they didn't live in the property and it wasn't their primary residence, and they
right.
can't qualify for any exemption. So what I would do there is it mitigates the tax position dramatically, because the parent is only responsible for the 1% of the gain rather than
Right. Their gain would
50%
be
of the gain.
tiny. Yeah.
The gain would be
Well,
tiny
not necessarily, but yeah, that would be the goal. Yeah.
relative to where it would be if
Yeah.
it was 50%. And then
Mm,
going to that same vein, if so for your buyers, you sell them a condo for 800,000 and they sell it for 1 2 years later, they've made a $300,000 gain there. That's 100% tax free. So as a homeowner, as a primary
yes.
residence.
Yeah.
So if you're renting it out, that's not. But in cases where you're buying a home for your primary residence, then you get to have that full gain tax
Mm,
free. So that's significant for,
yeah.
if you look at any graph over the last 20 years of house values, they've increased. They may have gone up and down a little bit, like riding an escalator, dropping a yo-yo was the best way someone described something to me once. Was the yo-yo will go up and down, but the escalator trajectory is still going up. But just in
Yeah.
the short time, it can go up and down. That is essentially a homeowner experience,
Mm.
but it'll most likely always go up.
And the fun part is it's also your emotions are doing that.
Yeah, true. And your finances and
I'm on the yo-yo on the
yeah,
escalator.
your needs and wants and all those other things that happen. But yes,
That is how it feels.
that's how it feels. Yeah. I mean, there's definitely a
Okay.
pride in painting your own walls and
Sure.
looking after your own home, and but there is an expense to that. You
Mm,
want to look through strata documents as a first-time home buyer. I always suggest that they read through the strata minutes, get their AGMs. They're important because you can get a real sense of what the the temperature of the strata is, how they're restrictive on A, B, or C. Are they going to implement new rules that you're going to find out after you buy?
hmm
So,
Is there a big special assessment coming down the line in 6 months that,
exactly.
yeah.
Exactly. So those are really good. I always ask my buyers to review, even if the lender doesn't need the strata minutes, I always ask them to review their strata minutes just because it gives them a really good feeling of the environment of the strata and become part of the strata.
Yeah.
Be part of the change, not the problems. You can be on the board. You can work with the strata if you become an owner of a property. It's
you can be
true.
involved and have a say in your building and what
You can be
happens. And if you
involved.
think one thing is important, or a hot tub, or a
Hmm.
whatever, different patio railings, I don't know, whatever. But there's a reason why you go and you vote. And yeah,
Yeah,
getting
and
involved in all that is kind of fun.
absolutely. I think those are the only incentives that I could find for the first time home buyers.
I think it's
Yeah.
great. And I think it's quite overwhelming. I know for our kids' age groups, talking about owning a home is almost not, it doesn't even really feel like a realistic goal to
Yeah.
have anymore in BC, and specifically in the lower mainland. But I think if they can utilize as much of this as possible, and like you said with the bank account, like get started now and put money where you can,
Yeah.
if you can. And I don't know if you ever listen or read The Wealthy Barber, but he'll say 10% of every check, just chuck it away into your investment and don't look back, don't think about it. You're not going to miss
Yeah.
it.
It's basic fundamentals 101. When you get a paycheck, don't put it all in a savings and don't spend it all, but
Yeah,
have some balance there. It is worth starting as soon as the time economics of money does
yeah.
work. Often I have clients that say to me, "Oh, I wish I'd bought last year." That's like probably one of the main veins of a statement a client will say to me is, "I wish I
Mm,
bought last year." So
yeah.
then you're sitting here today going, "Why don't you look to buy?" "Oh, I'm going to wait for the value to come down." Well, I
Till
think you and
next
I
year when you say, oh, I
are
wish
going
I
to
bought
have this
last year.
conversation next year where you go, "I wish I bought last year."
And we can say that all we want.
I
It just sounds
know.
like I'm trying to make you buy a
I
house.
know. And
Yeah.
I've been in this business for as a mortgage broker for 25 years, and I've heard it constantly through
Yeah.
my 25 years of career that clients are like, "I wish I bought last year." Depends on how you buy and what the configuration of your property is, but in a lot of cases, a roommate really works really well.
Yeah. And for the most part, like if you put it into, say, a 5-year plan, you can do that for 5 years. You get help with your payments, and then 5 years from now, you've made a massive investment and maybe
Yeah.
a really good friend.
And you touched on earlier about making the lump sum payments and the additional stuff the
Mm,
bank allows you to do. So, that's where you could become more disciplined in a sense that if you can afford it, you go to the bank and you increase your payment by $20. So it doesn't sound like a lot, but once a month your payment goes $20 extra or
mm.
$100 extra. And over the course of 5 years, suddenly you're chipping away at a pretty nice savings and you've not noticed that impact on your budget.
Yeah.
So
I've
that,
noticed on my, when I log into TD and I look at my mortgage, it will say
yep.
increase by this much, and it gives you a calculator,
Oh,
and
good.
it will say this is what you'll save on interest, this is what you'll save on your amortization months, just increasing by, like you said, $50, $100, or sometimes just rounding it up makes a difference.
Yeah.
And it's kind of fun to play around with that. Obviously, if you're able to and you can do that, it's as quick as on mine. It's as easy as hitting a button like, yes, I'll increase.
First time buyers often focus on how much can I pay down as lump sums. And it's like, well, that might not be your first focus. But what I would suggest you do is in a separate bank account, put the money aside so that for your first year, you've then accounted for all the unknown expenses that you may not have thought happened or
Yeah.
things that just happened because you're a homeowner. And if at the end of a year you haven't dipped into that account that you've created for the what ifs, then pop it on your mortgage and do that every year so that you kind of preemptively save for the inevitable water tank that eventually you'll need
Mhm.
to replace. But potentially you might not need to replace that for 5 years. So you're kind of, rather than being on your back foot and paying for it when it happens, have a little account where every month just a little bit goes into a separate account you don't touch and don't look at. And then if you ever need that money, it's there as your contingency fund for your own ownership. And if you don't need it, you've gone through the year and went, yep, everything was great. Then put that on your mortgage and start it again the next year.
Yeah. It's a safety net because there's always
Safety
something.
net.
It feels like there's always something. And if there isn't, yeah, like you said, great.
Yeah.
Yeah, you've that's your wealthy barber 10%.
And often you're putting it in to increase the value of your property because you've upgraded something.
Okay, so moral of the story is go get yourself a bank account, put your money into your RSPs,
Yep.
save, save, save.